Good morning, everyone, and thank you so much for joining today. My name is Hajra Talat, and I will be your host for today's webinar on understanding corporate tax base and calculation of taxable income. So, before we dive right into the webinar, I would like to give a brief introduction of our company. ACME Group has firmly established itself in GCC region and Egypt as a reliable tax and financial solutions company. We consistently provide high quality solutions catering to various businesses across range of industries. Our strength lies in our expert team members and their capabilities driving us to a rapid expansion. Our strategic approach of providing tailored solutions for each client keeps us competitive in today's challenging business environment. We prioritize quality and expertise, fostering long-term relationships. Our exceptional team consistently delivers value efficiently, making us the preferred service providers. So, moving on, I would like to give a brief introduction about today's webinar speakers that are Mr. Daraj Kumar and Mr. Milan Ibrahim. So, Mr. Daraj Kumar, an accomplished corporate tax, VAT, tax advisory, and transfer pricing professional with an extensive experience spanning over 8 years across UAE, Oman, and Saudi Arabia. His expertise lies in corporate tax matters, including compliance, advisory, and transfer pricing strategies. Honed through his tenure in Big Four firms, Daraj excelled in optimizing tax structures, compliance details, and providing guidance to clients, making him a reliable resource for the complex corporate tax challenges. His proficiency extends to transfer pricing, compliance, VAT implementation, and expert representation before taxation authorities, showcasing a comprehensive skill set in the realm of taxation. And Mr. Milan Ibrahim is an accounting and tax professional with a degree in commerce and an ACC affiliate. He's a tax consultant involved in tasks related to corporate tax registration, impact assessment, VAT ledger inspection, client data segmentation, and macroeconomic factor revision as per IFRS standards. With his expertise in corporate tax and compliance with regulations, makes him a valuable asset to our company. So before we dive right into the webinar, I would kindly ask our audience to share their valuable questions on the subject matter in the Q&A section. This will contribute to an interactive session and ensure that you derive maximum value from attending the webinar. Your participation is very important to the success of the event. And now I would like to invite and hand over the stage to Mr. Daraj Kumar to commence the webinar. Over to you, Mr. Daraj Kumar.
Thank you, Hajra. Before starting, we'll just go through the table of contents and the topics that we are going to discuss today. Uh, we will be discussing about tax base, like what is exactly the tax base and why do we need to understand the tax base. After that, we are going to discuss about the resident person, non-resident person, the permanent establishment, place of effective management. These are core topics that we need to discuss to understand more about the taxability of the persons in the UAE. Then we are going to discuss about imposition of tax and tax rate. What is the tax rate in the UAE? The tax adjustments that are required to be mentioned while calculating the tax return. And we are going to also discuss about the exempt income. In the last, we are also going to discuss about the corporate tax computation, like what will be the possible format of the tax computation. Uh, Before starting, we'll just have an overview of the corporate tax law in the UAE. So the law was published on October 10, 2022, and then it became effective on October 25, 2022. And the UAE Tax Authority released the Federal Decree Law number 47 of 2022 on the taxation of corporate and business tax on December 9, 2022. So the key definitions that we are going to discuss is about the taxable income and permanent establishment. So the taxable income will be any income which is taxable under the corporate tax law as per the UAE regulations. And the permanent establishment is something which is like a place of business or other form of presence in the UAE of any non-resident person. So that is defined under Article 40 of the UAE Corporate Tax Law, and we are going to discuss in detail. So the next we are going to discuss, we have a poll question. So we'll be asking you the question, and your countdown starts. That is going to start in like 30 seconds. The question is: for a juridical person, is the income generated from outside of UAE taxable or not? So the countdown starts now. Okay. Uh, so I hope you have guessed it correctly. Okay, so for all the juridical person who are registered in UAE and they are earning any income inside or outside of UAE, that is going to be taxable for them. Okay. Now we are starting from the tax base. Before understanding anything about taxation, especially the corporate taxation in UAE, we need to understand what is tax base and why it is important. So the tax base is like any income or any stream of the income which are taxable in the UAE as per the UAE taxation law. So that tax base is going to be different for juridical person and natural person. So juridical person are entities or persons who are registered or incorporated in the UAE as per any law applicable in the UAE. And natural person or like persons, the natural person like individuals, and they will have different tax base. So they are going to be taxable based on the business activity they are conducting in the UAE and not any other income or personal investments. For the juridical person, any income derived from their state or from outside the state in accordance with the provision of the UAE city law. So if any person, any company who is registered in the UAE for under any corporate tax law, they are going to be taxable on all of their income, whether earned from inside of the UAE or outside of the UAE. The natural person, on the other hand, will only be taxable on their income derived from or inside or outside the UAE based on their business activity only. So any personal investment for them are not going to be taxable. This is as per the Article 11 of the UAE corporate tax law. So we need to understand that there are juridical person and then there are natural person. The tax base for them is different, and we need to understand the tax base because there are many types of streams of the income which may be taxable, which may not be taxable as per the UAE tax law, because there will be some incomes which will be exempt. Moving on next slide. Now we have to discuss like what will be the tax base for non-resident person, because non-resident person are calculated on a different way and they are defined in a different way as compared with the resident person. So Article 11(4) of the UAE city law describes a non-resident person as like someone who has any permanent establishment in the state. So we are going to discuss in detail what is permanent establishment and how that is constituted. B, drives state source income. So someone who is a non-resident and earning any income from the UAE, so that may be considered as taxable. C has a nexus in the state. So maybe there will be some nexus or some connection of any non-resident person who is in the UAE and they are doing any business. So these three things will constitute taxability of the non-resident persons in the UAE. Now, for the non-resident person, the tax base would be so any taxable income that is attributable to the income of the permanent establishment of non-resident person. So we need to understand what is permanent establishment and if there is any income related to the PE of that person, uh, that is going to be subject to tax and that will be tax base for the non-resident person. The second point is state source income. So any state source income about any permanent establishment of any non-resident person is will be considered as tax base. Three, nexus. So nexus is something is there is any connection or any link of the taxable non-resident person in the UAE, and that is defined as per the ministerial decision number 56 of 2023. So for the non-resident person, we need to consider these 3 points to calculate the tax base, because from the tax base we are going to calculate the taxable income and the tax liability. So moving on to the next slide. Okay, as mentioned in the earlier slide, the permanent establishment. This is one of the core area to understand when we are going to understand about the tax base of any non-resident person. We need to understand what is the permanent establishment, how is it constituted, and what is the taxability of the permanent establishment. So permanent establishment is defined as per Article 11 and Clause 4 of the UAE corporate tax law. So this is any person who is not considered a resident person in the UAE and that is driving any income and that has some kind of establishment in the UAE. So first we need to understand whether there is some non-resident person doing any business in the UAE and do they constitute any permanent establishment or PE by virtue of any clause of the UAE corporate tax law. So Article 14 and Clause 1 of the UAE city law describes what is the permanent establishment for a non-resident person. Uh, Normally, the permanent establishment is going to be in the following three cases for any non-resident person. The first is fixed place of PE. Now, if any non-resident person is having any kind of fixed place for a business or like a permanent place in the state and where he is coming to do some business in the UAE, so that will be considered as a fixed place for permanent establishment. So there may be some kind of business activity, some office in the UAE, and that is considered as a permanent establishment. The second instance may be where there is someone conducting or working as an agency PE. So agency PE is something where any agent is working on behalf of the permanent establishment and it is not much independent. So he is working on behalf of the permanent establishment or on the behalf of non-resident person. So where a person has and habitually exercises an authority to conduct a business or business activity in the UAE on behalf of the non-resident person. The third instance can be permanent establishment due to nexus. So where it has any other form of nexus in the state as specified in a decision. So this can be because of having any property or any uh, like any kind of other business or any connection to the UAE. So in this situation can also be PE. So the PE can be constituted in these three situations that we need to understand in detail. So the first one we discussed was about fixed place in PE, second agency PE, and the third PE due to nexus. So this is about understanding the taxability and tax base of the non-resident persons. Moving on to next slide. One of the key areas that we need to understand is place of effective management and control, because for the non-resident person we need to understand how the PE can be constituted and where they are conducting the business, whether that is going to be considered as permanent establishment or not. So for that we need to understand whether the non-resident person is having any kind of management or control from the UAE or not. So this is mostly with regards to the foreign subsidiaries, and foreign subsidiaries are liable to corporate tax if we establish that the place of effective management and control is from the UAE. So that is, we need to understand through any subjective criterias depending on the business activity and decision making being carried out. So normally there are primary factors and secondary factors that we need to understand whether the business a subsidiary is being effectively managed and controlled from the UAE or not. The primary factors can be place of board of directors meeting. Now this is one of the critical area. Sometimes uh, especially this happens in the case of multinational companies, that board directors meetings are being held from some country or let's say from the UAE. So if this is happening, then the place of effective management and control for that subsidiary is going to be from the UAE. The second point in this is place of senior management and key management personnel's situation sitting. So we need to understand where the senior management and key personnels who are involved in the decision making, where is the place of those persons. So in this case, if the place of this decision making and senior management is in UAE, then the place of effective management would be UAE. The third one is shareholder influence. We need to understand where from the shareholder can influence for this decision making. So in that case, if we establish that this decision making and shareholder influence is from the UAE, then the place of effective management is going to be from UAE. So these are the primary factors that we need to consider. The one, place of board of directors meeting. Second, place of senior management and key management personnel's place. Third one, shareholder influence. Now we have secondary factors to understand whether place of effective management is from the UAE or not. That will be helpful to determine the taxability and tax base. So we have 2 points in the secondary factors. The one is place of residence of management and board members. We need to understand where the board members are situated and where are they located. The second point is place where accounts and financial statements are maintained. So in any case, if documentation and financial statements are being maintained from the UAE, then that point will be considered as a place of effective management and control, and they will be taxable from UAE. So that was about the place of effective management and control. We need to understand that the taxability of the subsidiaries, whether they are liable to corporate tax in UAE or not. Now, in the next slide, we are going to discuss about. We have a question here. There's a poll, and the countdown will be for 30 seconds. So the question is: are qualifying free zone persons taxable in the UAE or not? So the countdown starts now. So the countdown stops now. I hope you have guessed it correctly. So any qualifying free zone person, if any company was registered in any free zone and they are meet the condition, then they will be taxable in the UA. So if they are qualifying, then they will be taxable at 0%. They will get the benefit of 0%. Moving on to next slide. Uh, we need to understand how the tax will be imposed in the UAE and what will be the tax rate, because there are some exemptions and some benefits, some relaxation about the tax rate for different type of taxpayers. So we have majorly two type of taxpayers in the UAE. The first one is persons who are qualifying free zone person. The other, and there's an other category who does not qualify as free zone persons. So the one who does not qualify for free zone person benefit, they are going to be taxable at 9%. But the first 375,000 of their taxable income is going to be taxable at 0%, and any taxable amount above the 375,000 will be taxable at 9%. So this is for some persons who does not qualify for free zone persons benefit. Now we have second category. So this second category is about the persons who are qualifying free zone person and who meet the conditions about being qualified and being considered as free zone persons. So if they qualify, they will be taxable at 0%. If they do not qualify, they will be considered taxable at 9%. So there are two type of taxable person in the UAE that we need to understand. The ones who meet the benefit and conditions of qualifying free zone persons, and the others who does not qualify. Moving on to next slide. Now that was about the taxable income. Now we need to understand, are there any other streams of the income in the UAE when it comes for the corporate tax? So yes, there can be other type of incomes which may be exempt, maybe because of any exemptions provided in the UAE corporate tax law. So we need to understand the all the streams of the income which may be taxable or which may be exempt. So we have listed here few types of income which are exempt. The first one is, as per the Article 25 of UAE City Law, any income derived by a non-resident person from operating aircraft or ships in international transportation. So this is for the non-resident person. If they are earning any income from operation of the aircraft or ships in the UAE, that will be exempt income, that will not be taxable. The second is income of foreign permanent establishment. That is also going to be exempt. So we need to understand there are domestic permanent establishment and then there are foreign permanent establishment, and the income of foreign permanent establishment is going to be exempt as per Article 24 of the US City Law. Then the major point here is about the dividends and any kind of profit distributions. So we need to understand that any dividends or other profit distribution received from a juridical person or a resident person in the UAE, they are going to be exempt. So dividend is not taxable, and dividends are normally uh, like given after the calculation of the taxable income. Now we have other type of exempt income, which is any dividends or profit distribution received from a participating interest in a foreign juridical person. So if we have any kind of investments uh, from outside of UAE, and that is from the foreign juridical person, subject to meeting some condition, this income is also going to be exempt. This is defined as per the Article 23 of UAE City Law. Now, as per UAE City Law, Article 23, any income received from a participating interest, this is going to be impairment gains or losses, foreign exchange gains or losses, and any gains or losses or transfer, sale, or disposition. So, for these streams of income, if they meet the conditions as per Article 23, this income is also going to be exempt from the corporate tax law, and there will be no tax for these exempt incomes. So we need to understand there are taxable incomes and then there are exempt incomes as per the US city law. So exempt incomes we have defined, these are the some of the exempt income which may be exempt in the UAE, and some incomes will be only exempt if they meet some criterias or conditions as mentioned in the relevant articles. Moving on to next, we have another poll question here. Uh, the question here is entertainment expenditure wholly deductible for corporate tax? The countdown starts now. Countdown stops now, and again, I guess you have guessed it correctly. So, in case of entertainment expenditure, they are not fully or wholly deductible. They will be only deductible up to 50%. Moving on to next slide. Now, like after understanding what is the taxable income and what is the tax base, we need to understand how the tax liability will be computed. So there we have to make some kind of adjustment, and this adjustment can be deductible or non-deductible expenditure. The whole idea behind this is that there are differences between the taxable income as per the tax law and as per the accounting standards. So there will be certain types of income that will be not be allowable or may be allowable as per the tax laws, as per the understanding of the tax authorities. So we have some deductible expenditures here. So any income or sorry, any expenditures which are related to business and we have all the documented proof for these expenditure, that will be deductible expenditure. So we have to make sure that we have all relevant proofs and documents for those kinds of expenses. So we need to have invoices, maybe purchase orders or any other company policy document or something to prove that these expenses are related to business and they will be deductible expenditures. That is as per Article 28(1) of the UAE City Law. We also need to understand that these are not capital in nature. So any expenses which are in capital in nature, there will be separate deductibility for them in different way. But other than this, all the expenditure will be deductible. Now we have some special clauses for special class type of expenses. So let's say for entertainment expenditure, there will be only 50% of the deduction allowed. So the entertainment expenditure will not be completely allowed or wholly allowed. And we have special deductibility for net interest expenditure that we are going to discuss. Now, there are some expenses which will not be deductible as per the UAE law, which are specifically mentioned in the law. These expenditures are donations. So any donations to non-qualifying entities will not be considered. So we need to see whether if any donations, grants or gifts that we are going to make through any non-qualifying entity, they will not be allowed. So we have to make sure they are as per the qualifying public benefit entity as mentioned in relevant UAE decision. Then any kinds of fines or penalties are not going to be deductible. Bribes or illicit payments, recoverable input VAT, dividends, profit distributions made to honor of the taxable persons. So any kind of distributions or dividends made to any taxable persons, they are not going to be deductible. Tax on income imposed on the taxable person outside the UAE, so that is not going to be deductible. And any amounts withdrawn from the business by a natural person who is a taxable person. So these are the expenditure which will not be deductible. Now, there's one more point we need to understand. If there is any expenditure that is incurred for more than one purpose, but in that case, deduction will only be allowed for the portion. So we need to see whether they are for any uh, incomes related to exempt income or taxable income, and then they will be proportionally allowed. Moving on to next slide. So we are going to discuss in the next slide is about one question. The question is corporate tax calculated on net profit? So the countdown starts now. Okay, the countdown stops now. And now I hope you have guessed it correctly. So the corporate tax is calculated on the net taxable income after making some adjustment to profit which is coming from your income statement. So we have to calculate the taxable income as per the tax laws. Moving on to next slide. As discussed in the earlier slides about the net interest expenditure, so there's special clauses for the interest deductible deductions. So as per Article 30 of the UACT law, a taxable person net interest expenditure shall be deductible up to the higher of AED 12 million or 30% of the accounting earnings before the deduction of interest, tax, depreciation and amortization that we called as EBITDA. So the net interest expenditure will be deductible in full up to 12 million in relevant year. Any interest expenditure that is more than 12 million, then it will be only allowed for 30% as per the EBITDA. So we need to be critical about interest expenditure because these are not going to be allowed full. So if the expenditure is more than 12 million. So this is as per Article 30 of the UACT law, and there's also a ministerial decision, decision number 126 of 2023. So we need to be understanding that what are the expenses which will not be deductible. In the next slide, we are going to discuss about more about the deductions and deductible and non-deductible expenditures. Uh, Now, we also need to understand there will be no deduction in case if interest expenditure is incurred on a loan obtained directly or indirectly from a related party in respect of any transaction mentioned below. So, for the net interest expenditure, first we need to understand this is going to be allowable only up to 12 million. If any amount is more than 12 million, then it will only be allowed up to 30% of the EBITDA. But if any interest expenditure is with related to any loan obtained directly or indirectly from a related party, then we need to understand the following that this will be the transaction. A dividend or profit distribution to related party, capital contribution to related party, redemption, purchase, reduction or return of share capital to related party, and four, acquisition of ownership interest in a person who is or becomes a related party following the acquisition. So, if there is any transaction about the loan from a related party, then this deduction for interest expenditure is not going to be allowed. So only deduction will only be allowed in case if this is with related to non-related party and up to 12 million, that will be fully allowed, and any amount more than 12 million will only be allowed up to 30%, but that should be on the arm's length. Moving on to next. Now, when we understand what will be the tax base, what will be the taxable income, and what is going to be exempt income, we have to arrive at the taxable income. So to arrive at the taxable income, we have to make some adjustments to our accounting profit. So normally this adjustment will be to some items which are allowed as per the UAE tax law and which are not allowed as per the UAE tax law. These types of adjustment will be as follow: unrealized gains or losses. So as we understand that if any income or loss is unrealized, then this will not be allowed, or because this income is notional. This gain is notional and it is not realized. That's why it will not be allowed. So a taxable person preparing financial statement on an accrual basis may elect to take gains and losses on realization basis. So if an election is made, then only this will be allowed. Exempt income. So if we have any kind of exempt income, then we have to make adjustment for this to arrive at the net taxable income. So certain income and related expenditure shall not be taken into account in determining taxable income. Third one is reliefs. There will be certain kind of reliefs which we need to understand to arrive at the taxability. So these reliefs can be small business relief, qualifying group relief, business restructuring relief. So we have to consider about these reliefs to make any adjustment to arrive at the net taxable income. Tax losses. A tax loss can be offset against the taxable income of subsequent tax periods. So we have to make adjustment for the tax losses because the tax losses of previous period can be offset also, or even for the current period. So to arrive at the taxable income, we have to make adjustments for the tax losses. And then in the last, we have related parties. So any transaction with the related party that should be on the arm's length. So if they are not at the arm's length, then we have to make adjustments to arrive at the net taxable income. So to arrive at the net taxable income, we have to make certain adjustments to certain types of incomes or expenses which are either allowable as per the UAE city law or which may not be allowable as per the UAE city law. And this is going to happen because the laws regarding the tax are different as compared with the accounting standards. So there will be differences between the uh, taxability of these kinds of incomes and expenses. So the major items that we need to be aware of are any unrealized gains or losses, exempt income, reliefs, tax losses, and in last, related parties. So after making this adjustment, we are going to arrive at net taxable income on which we have to decide what will be the tax rate. So in the next slide, we are going to discuss. So we have a poll question uh, in this. So the question is, are dividends subject to corporate tax or not? So the countdown starts now. So the countdown stops here, and I hope you have guessed it correctly. So dividends are not subject to corporate tax. Moving on to next slide. Now, this is a very basic computation of the corporate tax. So, like the tax authority has not issued the tax format, but here is some idea that how the corporate tax is going to be computed. So we start from the profit for the period as per the income statement, and we make some adjustments to this profit as discussed in the earlier slides. So there may be some disallowed expenditure which are not allowed as per the UAE tax law, and we have to add them back. And then there will be some allowable expenditures. So after making these adjustments, we arrive at net taxable income. So once we arrive at net taxable income, now we have to see if there is a non-qualifying free zone person, they are going to be taxable as per the tax rate as per the slabs. So for the first 375,000 of net taxable income, the tax rate will be zero. and any amount more than net taxable income of 375,000, this is going to be taxable at 9%. So we need to understand first is about the tax base and how the taxable income is going to be calculated, and then this is the format for computation of corporate tax. This is just a basic format to make you understand that how the working is going to work. Okay. Now, moving on to next slide. Now, this is the summary of this presentation, that how we are going to reach at the taxable income. So, as mentioned earlier, first we need to understand what is the taxable income, what is the tax base for resident person, what is the tax base for non-resident person. So, like for the resident persons, all their worldwide income from the UAE or outside the UAE is going to be taxable, and for individuals or for the natural person who are resident in the UAE, only their business income is going to be taxable. Now, the tax base for the non-resident person will be different, as we discuss about 3 points: having permanent establishment in the UAE, having agency, PE, or any nexus in the UAE. Based on this, we are going to calculate the tax base for the non-resident persons, because non-resident persons are going to be taxable only on their UAE taxable income. After understanding the resident person and non-resident person, we need to understand there might be exempt income. So there will be certain streams of the income which will not be taxable and which are specifically mentioned in exempt income. So those are not going to be taxable. So we have to identify whether we have any kind of revenue coming from exempt income that is not going to be taxable, and any expenses related to this exempt income are going to be calculated on proportionate basis and they will not be considered. Then after understanding the revenue streams, whether they are going to be taxable or not taxable, we have to understand there are certain kind of adjustment that we have to make to our accounting profit to reach at the net taxable income, the income on which we are going to charge 9% of the corporate tax. So these adjustments can be for unrealized profits. Can We have to understand whether there are any exempt incomes, tax relief, non-deductible expenses, and other specified items. So we have to be alert about these kinds of items in the income statement, and we have to make some adjustments. So the adjustments can be through any expenses which are not specific, not related to business income. They will not be allowed, and we have to have all the proof of these expenses to make adjustments for these expenses from the income statement to arrive at the net taxable income. If these expenses are not for the business related expenses, or we do not have any documents for them, so these expenses will not be allowed. And in the expenses, we have specific deductions about entertainment and about net interest expenditure. So entertainment expenditure will only be allowed up to 50%. And for the net interest expenditure, they will only be allowed up to 12 million in full. And any expenditure related to interest is more than 12 million, then it will be allowed up till 30% in a tax year of the EBITDA. And any amount which is more than 30%, that will be carried forward to future tax periods. Now, any net interest expenditure that is related to related parties, that is not going to be allowed, because that may be not on the arm's length. Now, after understanding all these items, we have to arrive at the net taxable income, and on this income, we are going to charge corporate tax, whether at 0% or 9%, and that we need to understand. So, if there is non-qualifying free zone person, the first 375,000 of the taxable income will be exempt or taxable at 0%, and any amount more than 375,000 is going to be taxable at 9% for a relevant tax period. So we need to understand what is tax base, what is tax base for the resident person, what is tax base for the non-resident person, and then we have to identify whether we have any exempt incomes or not, and we have to exclude the exempt income to arrive at the net taxable income, and then we have to make some adjustments through the accounting income, and we have to make some adjustment to the deductible expenditures or any items which we are supposed to add back, because the tax laws and accounting laws are different, accounting standards are different, so there will be allowability or non-allowability for certain types of income and expenditure. So once we arrive at the net taxable income, we have to decide what is going to be corporate tax for this income. Moving on to next. So we are going to have question and answers. We are going to select some questions from the audience, and we are going to respond to you on those questions.
Thank you so much, Mr. Darash, for your insightful and engaging session today. And we have gotten an overwhelming response. I can see through the audience and their questions. Some are putting their questions in the chat section as well. I would request you to put your questions in the Q&A section so that we can take your questions and publish them accordingly. And there would be a one more request that I have for you people is to rate our today's content and presentation quality for the webinar before we dive into the live Q&A section and we take the questions and answers from our lovely audience. And I would like to say that due to time restraint, we won't be able to cater to all the questions, but we will try our best to take as many as possible. So I would now like to invite Mr. Dirash and Mr. Milan Ibrahim to take the question and answer session. And in the meanwhile, I'll request our audience to do the rating for the webinar as well. Thank you so much.
Thank you, Hajra. And thank you, Durash, for this wonderful session. So we have plenty of questions from our audience today. So let's get to it one by one. The first question here is a very common question from most of our clients also. The question is, our corporate tax period is March to February, different from financial year, which is January to December. Do we need to change corporate tax period? How? Our registration is already done.
Sorry, mic was off. So this is one of the critical question, and normally this happens in most of the registrations. So of course, the tax period should be same as per your accounting period, and that should be allowed by the tax authority. So you need to uh, communicate this with the tax authority to get it sorted out.
Yes, rightly said, Mr. Durash. So we have a amend option in the portal where we can change this tax period. So we just have to make application to the FTA to make the change.
Yeah.
Yeah. So we have another question from Mr. Despo. Is it required for a government license office in Dubai with a trade license to register for corporate income tax?
So that's again an interesting question. So what are your thoughts on this, Milan? That should they be allowed or should they be registered or not?
Yes, Durash. As per the FTA, all the companies should be registered for corporate tax, whether it is government or private. And in the portal, if you look, there is an option where we can select which option, like the private or government. There's a separate option for each, so we can proceed accordingly.
Yeah, rightly said. So the taxability or non-taxability of any business will be only considered registered, and then the FTA, we can give the proof to the FTA that okay, we are coming into exempt business nature or not. But to prove this, to establish this, we need to get registered with the tax authority for the corporate tax.
Yes. So moving on, there's another question from our audience. What is the difference between the juridical person and natural person? And how do I know which one I am?
So, Milan, how, what are your thoughts on this? Because we need to understand whether someone is taxable or not, and there are different type of taxable persons. So, what can be the adopt on this?
Well, juridical persons normally consist of LLC, establishments, etc., whether it is in mainland or free zone. And when coming to natural person, they are individuals, whether they can be sole proprietorship or sole establishment, etc. So when registering, we understand what entity type you're going to choose, and this will also be reflected in the trade license of the company.
So, rightly said, to elaborate more, we need to understand, uh, as per your trade license, how you are categorized. Are you categorized as any kind of LLC or free zone person? So, that means you are going to be considered as juridical person and you will be registered as per any law in the UAE. And normally, the natural persons will be individuals who are not registered or not considered as per any other corporate law in the UAE. So, based on this, we'll distinguish whether someone is juridical person or natural person. So, this is something we need to understand, and if that will be mentioned as per your trade license. So, based on that, there will be taxability.
Yeah, very correct. So moving on to the next question from Mr. Abaid. Can there be a PE risk for qualifying free zone person which has a main license in mainland or is controlled from head office in mainland?
Uh, of course, there will be. Like we need to understand whether they meet the permanent establishment definitions or not, or how they are going to be considered on that. So we need to understand whether they are domestic permanent establishment or foreign permanent establishment. So based on that, the taxability will be considered. And what are your thoughts on this, Milan? Also.
Yes, if this is relating to domestic permanent establishment, the functions or the core operating income generated from the place is considered.
Yeah.
Yeah, so moving on to the next question, very common question from most of the clients. Uh, the first 375,000 dirhams is based off in the overall income that accumulates every year, or is this first 375,000 per year or every year?
So, Milan, that's one of the basic question we need to understand. So this 375,000 is for 1 year and that is on the net taxable income and not on the accounting profit. So we start our working from the accounting profit and then we make some adjustments to arrive at the net taxable income, which will be allowed as per the UAE tax laws, because the income from coming from your income statement is different, as because this will be from accounting standards, but we have to arrive at some income which will be allowed as per the UAE tax law, that we call it net taxable income after making some adjustments. So on this net taxable income, any income up to 375,000 will be at 0%, and any income more than 375,000 will be at 9%, and that will be for only 1 year, one accounting period.
Yes, the Rush, that's very clear. So we'll move to the next question from Mia. Are impairments, gains, loss on forex, and dividends need to be deducted from accounting income before calculating the taxable income, correct?
So impairments or any other expenditure which are allowed as per the IFRS, they will also be allowed for the UAE tax law computations. And with regards to the gains and losses, we need to understand whether they are realized gains or losses or unrealized gains or losses, because the tax authorities only allow the realized gains or losses and they do not allow any notional expenditures which are calculated based on accrual kind of accounting. So we need to understand whether they are realized or not realized, and whether any expenditure is as per IFRS or not. So based on that, there will be deductibility.
Yes, just to add point on the dividend, normally dividends from domestic shareholding will be exempt without condition, but dividends paid by companies will not be deductible for corporate tax purpose if the dividend is after profit.
Yeah, rightly said that dividend is also one of the critical point that we need to understand, and dividends are normally not taxable.
Correct, correct. So we have another question, very vital question in for the purpose of corporate tax, from Deepika. How related parties' loan interest will be checked at ALP?
So normally, if there are any kind of transaction with the related party, we advise that you need to have a benchmarking study for that. Uh, from this benchmarking study, we need to we establish that whether this transaction is at arm's length principle or not, because for any related party they will only be allowed if they are at arm's length. If they are not at arm's length, they will not be allowed. So to establish whether they are at arm's length, we need to do the benchmarking study for all kind of transaction with the related parties and key management personals.
Yes. So in for databases, there are many databases available as of now. One of the famous one is Moody's. So we perform the benchmarking for loan there. There's like lower range and upper range of interquartile range. So lower range is 8%, and let's say upper range is 16%. So suppose your loan is 14 percentage and it falls under this category. Yes, it will be in a arm's length principle.
Yes, rightly said. Benchmarking are conducted through some databases which are available and which are globally accepted by the tax authorities all over the world. So we need to do benchmarking for related party transactions.
Right, right. Moving on to the next question, we have a very common question. Uh, when paying salaries to employees, is this deductible from corporate tax?
Uh, Salaries are related to your employees, then they will be deductible because they are business expenditures, and we need to have all proof like recruitment proof, the documents, the HR policies manual, and bank transaction proof to prove that these are paid to bona fide employees and which are on the visa of the company. So these salaries will be allowable expenditure. But we also need to be alert about the point that whether these are paid to shareholders or owners of the companies, because if the salaries or any kind of distribution is being made to any owners, then they will not be allowable. But the salaries to full-time employees, they will be allowable, given that we have all the expenditures proof for these transactions.
Right, that's very clear, Mr. Darash. So I hand over to Ms. Hajra now.
Thank you so much, Mr. Diraj. Thank you so much, Mr. Millen. Thank you so much, our lovely audience, for putting up your questions. I can still see a lot of questions coming up, and we would love to, answer all of your questions. But due to time restraints, we won't be able to entertain any more questions. But it was an overwhelming response, and the audience have put up so many questions. The hands are still raised. I would still request you all to keep putting your questions in the Q&A section, and our business development team will try to reach out to you, and we will try to have your queries answered as much as possible. And thank you so much, our speakers, for the wonderful session that we had today. And the poll section that we had at the end for the webinar's response has gotten a response, overwhelming response as well. Thank you so much for giving your feedback. And in order to make sure that we respond to your queries properly, you have our details on the screen. And for any other queries related to VAT, corporate tax, excise, kindly drop us an email or give us a call. Details, as I mentioned, are on the screens. And thank you so much again for joining us today and making this webinar a very successful webinar. Thank you so much, everyone. Have a great day ahead.